It's a shame this property only has one photo. It looks kind of cool. I was hoping to see what it looks like inside. Um, oh well. Let's see if there's enough information to actually see if there's a way we can see if this property can justify the income. Actually, you know what? This is a good property to show you my process for figuring out market rents and appreciation values and things like that on something where data is very scarce. And this property has been on the market for 1,300 days. That's what, 4 years? Jesus Christ, something's got to be wrong with it. Who knows? Anyway, my name's Rajesh. I am a 2 to 8 unit multifamily lender located in Los Angeles. And let's get into my process for underwriting a building from both the lender's point of view and the investor's point of view. And as a lender, I actually look to make sure that a property makes sense for the investor. Because if they're not going to cash flow, they're going to have a hard time keep making the monthly mortgage payments. So the two processes are very similar, but there are parts where it deviates. For example, as a DSCR loan lender, I don't really care if the property cash flows. All I really care about is that the gross rents cover the monthly mortgage payments. And you're going to ask, who's going to be stupid enough to buy a property that doesn't cash flow? And I'm going to show you in today's video that it doesn't really matter if the property doesn't cash flow, at least in Los Angeles, because equity appreciation rates are so high that once you sell the property after 30 years, if you just think of the losses as dollar cost averaging in the stock market, where you're making monthly payments and just buying the same shares, buying extra shares of the same stocks or funds like the S&P 500, it doesn't matter whether it's up or down. You're just putting your own monthly income into it as if it was a savings account. And then 30 years later, it's gone up ridiculously high. Same idea with rental properties. So it doesn't really matter if it doesn't cash flow in Los Angeles. Now, of course, it's better if it cash flows, but it doesn't matter if it doesn't. And today I'm going to show you that right here. So this property costs $998,000. So I'm going to go on this calculator that I made. Vacancy doesn't even matter because it's a 1 to 4 unit. So because it's a 1 to 4 unit, we can use market rents to qualify the vacant units. And if all 4 units are vacant, because it's not a commercial building, like a 5+ unit would be considered, we can use market rents for all 4 of the vacant units. So let me punch in this address here and go to ChatGPT and say, hey, market rents for this building. Based on similar setups in the neighborhood. So let's see what it says. Four units, 10 baths, 10 bedrooms, 5 baths. Average rent is $16.25. Median rent. The unit in the same building shows a market rent of $16.25 for that unit. So we already know they're renting below market. Median for the area is $2,000. studios for $1,500, one bedrooms for $1,800. So studios and one bed between $1,600 $1,675. So let's see here. So ChatGPT is saying $2,500 a month per unit if we upgrade, $2,000 a month per unit as is on average. I'm actually going to be more conservative and say, hey, current rent is $1,625 and one beds are $1,800, so let's go with $1,625 because that's what it's currently going for. I believe, yeah. 1625 times 4, 6,500. Doesn't matter. Property taxes. Now, on 4-unit buildings, operating costs are pretty minimal. You just really have to deal with property taxes and landlord insurance. So our minimum DSCR ratio is 1.0. On a bank loan, it's actually slightly different on a 4-unit building. The way they do that is they look at the gross rents, multiply it by 75%, and your minimum down payment is 25% down. On a DSCR loan, your minimum DSCR ratio is still 1.0, and that's based off gross rents, but the minimum down payment is actually 20%. So now you're at 0.9 at 80% with an 8.25% interest rate. But if we take it at, let's say, 7%, 7.125 maybe, you're at 21% down. And again, this is fully amortized. So versus a bank loan like a Fannie Mae, Freddie Mac, conventional loan basically, your cash flow is higher with the DSCR loan versus this, despite this having a lower interest rate. And that's because the interest rate is lower, the down payment is lower. So you're saving money, $207,000 versus $249,000. Now technically a down payment is just moving money from one bank account to a house-shaped bank account. You're not actually paying it, you're just shifting accounts. But it's still nice to be able to keep that money and still put it in this house-shaped bank account, leaving it in your bank account, then being able to use it whenever you want. That means staying liquid. So that's the beauty of lower down payment. So technically it's not an expenditure, but it's also not beneficial in terms of liquidity. And you can see here with this property at $6,500 a month on a bank loan at 25% down, you're grossing or you're netting almost $900 every month. So let's see this right here. 900. Well, let's go 899 divided by 6,500. You're looking at a 13.8% return on capital, or rather a 13% profit margin. Okay, that's a 13.8% net profit margin. Assuming all those other expenses are zero and outsourced to the tenants, of course, like utilities, etc. You take this down to 75% as well. This is 311, but again, this DSCR ratio is based on, well, no, the difference here is because of the interest rate, because your down payment is roughly the same, $250,000, but because of the higher interest rate, your monthly payments are higher, which means your cash flow is less. So let's see if we could get this to a 6.125. What does that look like? And at 80% or $200,000 down, 476. You put in, You take it down to 75% down, and it's still, yeah, the interest rate is higher, so your cash flow is less. Let's see what it looks like at interest only on both loans. Now, on a 4-unit, you're not likely to get an interest only loan. I mean, at a bank on a conventional. At least I don't think you're going to get one, but here you would, and your net cash flow is $1,500 a month versus $1,600 a month. Versus $900 a month, because I don't think you're going to get interest only on a bank loan for a 4-unit property. Now, for 5 units and up, you're definitely going to get interest only because it is a commercial loan. But on regular investment property loans from a bank, I doubt you're going to get interest only. So you're going to get $1,500 a month here. And you're like, well, I'm never paying down equity. That's correct. But equity is the difference between the value of the house and the balance of the debt. If you're not paying down the debt, that means the value of the house still has to keep going higher in order for you to increase your equity. And fortunately for you, this place is in LA, and so property values rise pretty quickly. So let's see what this looks like here. Average annual appreciation rate for this property and ones similar to it over the past 30 years. To it and near it over the past 30 years. So let's see what ChatGPT says about that property appreciation over there. And then we'll punch it into the cash flow calculator or the deal analyzer and see whether this is a good buy over the long haul over the life of the loan, actually. Over the next 30 years. So let's go back here. Property was 998. 998.3. Property address is 716 McDonald. Property taxes are 1.25%. Realtor commissions. Property management fee. We're not going to be doing any property management. We're going to be self-managing it. Let's say down payment of 20%, 7.125. Closing costs roughly 3%. Mortgage insurance, no. Interest only, period, no. Now, look at this calculator here. When I go interest only, here's a balloon payment. So you're doing $998,000. Your equity is roughly $200,000 right there. You can see that right here, the down payment or equity at starting costs. So loan amount, we're not doing any rehab here. Yearly inflation, we'll get all that information. Economic conditions right here. Economic conditions, yearly inflation, yearly appreciation, rental inflation, and vacancy. I'm going to assume 8% vacancy. That's pretty standard with long-term rentals. 30-year appreciation, 5.85%. Okay, so we're going to put yearly appreciation 5.85%. And let's see rental inflation. Rental inflation for the same average yearly rental inflation over past 30 years for the same. So in my submarket, in this submarket, Wilmington, California, you're looking at average of between 4 and 5%. So let's say 4% here. 4. Now we got to figure out yearly inflation. Now do yearly inflation for the same area. Okay, so they're saying yearly inflation is about 3%. So let's say 3%. After repair value, equity projection, so projected ARV price, I'm actually going to put in the same as purchase price because we've not forced any other appreciation by rehabbing it. It's got 4 buildings, 4 units, 1625, so we're looking at 65. Estimating an 8% vacancy ratio, so we're looking at 5980, averaging out the equity or the vacancy as a loss. Right here I'm putting in all the operating expenses as 0. And what we see is at the end of the first year, your net operating income is actually $50,000. End of the first year, total gross income is almost $72,000. But that doesn't really mean anything until you subtract the debt service. And the debt service is almost $57,000 a year at 7.125. Let's say you got a 6.999% interest rate, what that would look like at 20% down, and you're still at a loss. Your debt service is $55,000. So at this point, you can either put more money down to shrink the loan amount and probably get this down to 6.625%, maybe even 6.5%. Let's see what that looks like. Now your debt service is less than your operating income, and that means you end up with a profit of $920, almost $1,000 for the first year. And your second year, you actually lose almost $6,000. Then in your fifth year, you start building back up. So this is a good example of where cash flow just barely covers the cost of the building. But let's go back up to 20% down and keep this at a 7.125% because I want to illustrate what happens while despite having negative cash flow, you're still going to end up on top. So the first 5 years, you've got negative cash flow. From your 10th year on, you've got positive cash flow. And over the entire term of the loan, the entire 30 years, you get about $459,000 in cash flow. So let's see what that looks like on average. 459,218.64 divided by 30 years, you're supposedly earning an average of $15,000 per year in positive cash flow. Now, as you can see here, as you can visualize here, it's actually stacked so that your first few years are losses, and then every year after the 10th year, it starts building up. From a net income standpoint, you're writing off the mortgage and interest expense as well as the building depreciation, which means you take the price that you paid for the building and divide it up over 27.5 years, which is the standard depreciation schedule or calendar timeline. But here's the interesting thing. Look at the exit portion here. This basically looks at the net equity, the appreciation value of the building, and the net cash flow, and adds them together because those are positives for you, and then subtracts the realtor commission at the time of the sale at a rate of 3%, and how much money you would end up with in your pocket after all was said and done. So your first year you lose $153,000. Your fifth year, you lose $128,000. So you don't start making any money until your 10th year. You only gain $22,000. But in your 20th year, you walk away with $864,000. Your 30th year, you walk away with $2.9 million. Overall, if you add those all up over the lifetime of the loan, you're actually walking away with $3.3 million in your pocket over 30 years for a building that literally has a sticker price that's just barely less than $1 million. And that was for fully amortized. Now let's see this was interest only. Let's see what happens when we go fully amortized here. Okay. So we go back down to exit. Now, your 10th year, you're walking away with $28,874 in your 20th year, 30th year, $2.9 million. And if you look it up over the lifetime of the loan, you're at $3.3 million, over $3.3 million. There's not much change, but in terms of cash flow, it's pretty dismal. We're talking about losing $14,000 in your first year, $12,000 in your second year. Total fifth year is $6.136. So let's say we go interest only, right? The rehab cost, let's say it costs $100,000, right? To fix it up, modernize it, so that you can get higher rents at the 2% rate, right? And also you don't do 20%, let's leave it at 20% down and we'll explore other options later. And after the rehab, you put in $100,000, now it's worth $5 million, right? Because it is a 4-unit. Well, but it is also Wilmington, so you put in $100,000, $1.1 million, $1.1 million. Let's say $1.3 million realistically. Okay, you forced it up to $1.3 million, but now you can get, instead of $16.25 a month, you can get the average of, let's say, $2,000 a month, right? So let's see what that looks like over the lifetime of the loan. Your first year, you make $1,000. Your second year, you lose about $5,000. But your fifth year, you're $3,000, and every year after that, you're cash flow positive, netting over $1 million in just pure cash flow over the lifetime of the loan. Your net income negatives for the first 10 years, then 20th and 30th years. You're you're positive on it, right? So your 20th year, you show $18,000 in net income after depreciating everything. Barely any taxes to pay on that, so you might keep it all the way until the 30th year. 30th year, you've got $76,000 in taxable income. So you might decide, hey, I want to sell it before that, so I don't have to worry about taxes, because you've squeezed out every drop of depreciation you can. Tax benefit, rather. You've squeezed out every bit of tax benefit as you can. So you might choose to sell it. But let's take a look what that does at the end of the first year in terms of exits. So your first year, you can walk away with 40 grand in your pocket, almost 41 grand. Second year, 45 grand, almost 46. Fifth year, $117,000 cash flow, net, not cash flow, but profit. 10th year, 364. 20th year, $1.5 million. 30th year, $4.2 million. Total return over the lifetime of the loan, you're looking at $5.2 million. That's $2 million more, or $1.9 million more to be exact. And you're still at 20%. You're still at the same interest rate. You're still at interest only. The only difference is you put in $100,000 extra into rehabbing the building so that you can raise the rents from $1,625 to $2,000. Now, let's say what happens if you increased it from $1,625 to $1,800. You cannot get $2,000 a month. Let's see what that exit looks like here. you're at $4.7 million, $4.75 million, which is still more than 3.3 that you originally had just by changing nothing. So $100,000 transforms into an additional $1.4 million benefit. So let's say you put 25% down here, right? And you get 6.625% interest rate, and you don't put anything into remodeling it, and you just raise the rents. You just go from 1625 to whatever the market, whatever California will allow you, which is 1625 times it was inflation plus 5%, right? So let's say you just raise it by 1.05. So that's 1706. So let's say 1705, right? Everything else stays the same. And here's your exit, $5.3 million. So you don't even have to really improve the building. You just have to put more money towards the down payment from 20 to 25%. So let's say we're on 998, right? So we're going to look at this equity portion right here. And we're going to go from 25% to 20%. So you're here at $200,000 down with 20% down payment. I originally said 20% down and put $100,000 into improving the building, right? So your down payment still stays at $200,000, but now you put in another $100,000, which means you're in for $300,000. So $200,000 plus $100,000, you're in for $100,000 for $300,000 total. But if you just forget the improvement, forget the rehab loan, forget fixing it up, and you just raise rents by the permitted 5% per year, you're looking at, or 5% when you get in, and then just let the market average yearly appreciation take over, which was what, 3.5, 4%, something like that, every year thereafter. And you just put 25% instead of 20% down. You're putting in an extra $50,000. Your equity goes from $199 to $249. So that's a $50,000 increase. But this was a problem here. So we started with a valuation of 1.3 because of the improvements that we did. So that's my bad. All that, I guess I gotta cut out, or maybe I'll just let you see my mistake. But let's see what the exit is. So your $50,000 turns into $3.8 million here. So I don't know. I think it would be worth it to buy it at 20% down, even at the higher interest rate, 7.25%, or sorry, 7.125%, and put in $100,000 into rehabbing it, right? And now you can get a $1.3 million valuation. Raise your rents to $1,800 a month instead of staying at $1,625 or even $1,705. But you know what? Let's see what it looks like at $1,705, right? Your walkaway is $4.5 million after 30 years. $4.5 million on a $1 million building. Let's say we took it up to $1,800 a month on average. $4.7 million still. Wait, what happened there? That doesn't make sense. 4.7 versus 4.5. So, yeah, not a bad deal. And remember, you are cash flow positive here. When you do this, I believe the rehab loan would not be 6.5%. Let's say you do it out of pocket, just one and done. You have that cash sitting there. you pay for it out of pocket. So now you see that your rehab costs, your monthly rehab costs are zero. So for your first year, your net cash flow, you lost 99,000, but by the fifth year, your cash flow positive. Your exit at the end of the second year is pretty good. And then you walk away with $5 million just by choosing to pay for the rehab costs in cash instead of financing it. If you do decide to decide to finance it, so let's say we're doing 10.49, and this is 10% down for an experienced rehabber. Let's see what this looks like. So your first year, you're actually at a loss for the first 10 years at 10% down because the loan amount is so high and the debt service costs are so high. As a result, your net income is a loss, and your exit is also a loss because your equity isn't appreciating as much as it could because you don't have much equity to begin with. You have $301,000 after the rehab is done. So 20% seems to be the winning strategy. Let's say you rehab it, right, at 7.5, and this would stay at 100,000 right there. And yeah, it'd be 6.625. Let's add a zero here. So yeah, the goal is to walk away with close to $4 to $5 million. You have 10 of these buildings. That's 10 similar buildings in LA. That's $50 million after 30 years. But again, the point is to show you that cash flow does not matter. In each of these cases, it did not matter whether I was cash flow negative for the first 5 years or the first 20 years or the first 10 years or the first 30 years. It just did not matter. I was still walking away with at least $3.3 million as is without even touching anything on this loan. It was just a simple 20% down and a 7.125% interest rate. And this is interest only, so that my cash flow did not hurt me as much. 16.5. Yeah, so like I'm cash flow negative for the first 5 years. 10th year, I'm not making anything. 30th year, $32,000. That's not even a part-time job anymore. My exit, I'm losing money for the first 5 years. 10th year, I'm barely walking away with anything. 20th year, I'm $800,000 ahead. 30th year, I'm $2.9 million ahead for that year. Over the lifetime of my property ownership, including all the cash flow that came in, I'm at $3.2 million. $3.2 million. So that's how the LA property game is played. You want to make sure that you're buying properties that appreciate quickly. And that's at 5.85%. That's less than the S&P 500, which is 7 to 10% per year on average, closer to 10. So if you get this, you get a property that cash flows, you get a property that has appreciation of at least 8%, you're actually going to beat the S&P 500 because with the S&P 500, you have a dollar cost average, meaning to take, let's say, the same down payment, right? You take this $200,000 down payment and you buy your first stock. And then every single month after that, your monthly payments here are $47.40. So you're taking right? That's $47.40. So you take that and you just put it into the stock market every single year or every single month. You're putting $4,700 every single month on top of the original $200,000 you put in. And you're just buying more shares of the S&P 500. That's dollar cost averaging, because sometimes stock price is high, sometimes the stock price is low, but the amount you're putting into it every single month remains the same. What that is actually a benefit for you, because on the stock market, it just means you're acquiring a bunch of shares and letting the appreciation do its thing. But on a rental property, you're still putting that same money in, but you're getting some of it back in the form of rental income. And if you're lucky, you get more rental income back than you actually put up into the property in terms of mortgage payments and operating expenses, which on a full unit is generally limited to property taxes and insurance. So you're putting money into the building, you're dollar cost averaging into the building, but you're getting back rental income. Now, generally speaking, when we look at an equivalent on the stock market, we're looking at dividend stocks, right? You buy stocks and you get a dividend back, but they don't generally give you the same returns as rental income, because they end up being a fraction of the stock price. The yield is pretty low, whereas the yield on a rental property is much higher. So even with something that is cash flow negative, it just means that you're not losing the full $4,700 a month that you're putting in, plus property taxes and insurance on top of that, but just sticking to principal and interest. You're putting in $4,700 a month, right? But you're getting back $1,700 per unit. Let me see here. Yeah, in net operating income, we're getting back roughly 17. No, this doesn't make sense. I misspoke. Net operating income. So you're putting in $4,750, right? $4,750 times 12 is $57,000, but you're getting back $50,000. So really, you're only losing $6,000 of your income into that dollar cost averaging, and you're still getting the benefits of appreciation. And that appreciation really takes note on when you look at it over 30 years. So let's say you bought it at $1 million. At the end of 30 years, it's now worth $2.9 million. It's gone up 3 times in value. And you've also collected all this net cash, which limited your dollar cost averaging. So you walk away, and in some cases like this, you actually got more cash back than you put into it. So you walk away with a total of $3.2 million in the worst case scenario, which is you leave the rents the same, $1,625. You put down the least down payment necessary, which is 20% on the DSCR loan. You take a high interest rate like 7.125, which would be the par rate on something like this, and you don't do anything else. You just keep it fully occupied. That's it. You maybe an 8% vacancy, but for the most part, fully occupied, long-term tenants, and you just raise rents 4% every year. That's it. If you only do that, you're walking away with $3.28 million, almost $3.3 million. Now you want to get fancy and you buy down the interest rate, right? So you buy it down and you have the seller pay for it, so your closing costs stay the same. And you buy it down to a 6.625% interest rate. Let's see what your exit is. It's $3.4 million. So that took you from 3.28 to 3.48, almost 3.48. So that's a $200,000 gain. Now let's say it cost you $25,000. Let's say it cost you $50,000 to buy your interest rate down from 7.125 to 6.625. Is it worth it on that scale? If you're willing to wait 30 years, absolutely. Now let's say you take this and you buy it in an area that appreciates at 8% a year, right? And you still stay with the 7.125% interest rate. Let's see what that exit looks like. $6.8 million. For the same $200,000 down payment, same rental income, without changing a thing, all you did was change the area that you bought the place in from a place that appreciates at 5.8% a year to 8% per year on average over the last 30 years. Now you are at a $6.8 million exit. That's twice as much. That's twice as much as what you were walking away with, which was $3.2 million, $3.3 million. So a little more than twice as much. And that's a difference in appreciation of 5.88, so like what, 2.2? 2.8, my math is not working right now. 8 minus 2.8, 5.8, 2.2, yeah. And this is keeping rental inflation at 4% a year, yearly inflation at 3%. Now, this is going to get worse if this rental inflation is higher. Let's say we use rental or regular currency inflation of 3.5% a year. Let's see what that exit looks like now. 6.78. It's not much. Not much of a difference. Your net cash flow is negative $28,000. This is actually good here to check it out because your net cash flow is your 10th year, you're $44 up ahead. 20th year, you're $15,000 up ahead in terms of cash flow. 30th year, you're at $18,000. But your cash flow is negative $28,000 over the lifetime of the loan. But you're still walking away with $6.8 million just because you bought it in the right area, which appreciates at $8,000. Now you use that same idea of the rents, taking care of that dollar cost averaging for you, so you're not having to dip too much out of your pocket as you would with the S&P 500. And all of a sudden, you can see why real estate in LA is still very attractive, despite all the laws, despite all the hassles. It's still very attractive.